What's the difference between mutual funds, index funds, and ETFs? Maybe at one point or another you've heard these terms being used, but you're not sure which one to go all in on. This is a pretty important decision when it comes down to it. Many people mix these up, and I know it's easy to get them mixed up, but some of these things I didn't learn until later on in my investing journey, and I had to switch from ETFs to index funds because of this one important feature. How annoying. I want to save you the hassle of having to do this like I did. So if you want to know the difference between mutual funds, index funds, and ETFs, keep watching. Before we jump in, go ahead and hit that like button and subscribe so you don't miss a video. If you do that, it'll help support this channel. My channel is about investing money and personal finance for beginners, and I know you're gonna learn a ton. Now, let's start with mutual funds because they've been around the longest. You guys already know how I feel about mutual funds if you've watched any of my previous videos, but let's jump in here because I think it's super important for us to go over the history of mutual funds leading up to index funds and how it impacts a good investment strategy. So Hamboy Das, in his economics textbook, Perspectives on Financial Services, traces an early appearance of mutual funds to a Dutch merchant, Adriaan van Ketwich, who created an investment trust in 1774. Ketwich probably believed that diversification would probably appeal to investors with minimal capital. The name of that fund in the early 1770s translates to Unity Creates Strength. Other early known mutual funds began to follow, including an investment fund in Switzerland in the 1840s. A similar vehicle formed in Scotland in the 1880s. These were created as a way to pool money and share profits. Now, the idea of pooling resources and spreading risk using closed-end investments found its way to the US by the 1890s. The Boston Personal Property Trust, formed in 1893, was the first in the US, and it might be better described as a hedge fund more than a mutual fund. But we'll save that for another day. There are three major benefits when it comes to mutual funds. Now, the first is convenience. By owning a mutual fund, you're buying into a basket of stocks all in one shot. So this means if there's 500 companies that you want to invest in, you'd have to go in and purchase shares in each one of these companies 500 times. By buying into a mutual fund, you only make one single purchase. Does that make sense? The second thing that owning a mutual fund does is it gives you diversification. So rather than having all of your money in one particular company or one particular stock, you spread your risk out over multiple companies. So if one company begins to go under, you're still invested in other companies as well. The third thing that owning a mutual fund does is it's managed by professional investors. So this gives you instant access to professional money managers. However, this doesn't mean that it's foolproof. Obviously, having access to professional money managers means you're paying for this convenience. This is really important. Now, having access to these money managers also comes with a cost. They typically charge anywhere from 1% to 5% in fees. The vast majority of mutual funds are not the best investments, actually. I'll leave a link in the description below on another video I did regarding picking stocks and how difficult it is for even an Ivy League educated person to pick a winning company. So let's just say at 2% in fees, if you invested $10,000 into this particular fund, $200 of that goes right into the mutual fund manager's pocket. Now let's take this a step further. If you lose money the next year that you have your money invested into that particular mutual fund, your fund manager still gets paid regardless of whether or not you are making money or losing money. But even if you find a fund manager that does really well at picking the right stocks to put into this mutual fund, according to a 2020 report over a 15-year period of time, it's actually 90% of actively managed funds that fail to outperform their relative index. Portfolio managers are often Ivy League educated individuals who spend their entire workday attempting to outperform the market, but yet fail to do so. That's how difficult this is. Then Then came the index fund. Let's jump to index funds. And this is where things really get fun. I love index funds. Jack Bogle, the founder of Vanguard, got so sick of mutual funds and the inability for the average person to get an average rate of return, remember mutual fund managers fail to beat the market over 90% of the time, that he created a whole new category of mutual funds. He created the index fund. Jack created the first index fund that mirrored the S&P 500 index in the 1970s, which is one of the most widely followed indexes in the world. The S&P 500, for example, simply buys the stocks that are in the S&P 500 index, and this keeps the active management fees much lower because you are not paying for active management. You're not paying for an expensive fund manager to buy and sell things for you. Unlike traditionally managed funds, index funds are passively managed, meaning that rather than paying an expensive fund manager to do active management, the fund follows a fixed formula that eliminates the need for active management. The formula is based on an index, which is where the term index fund comes from. An index is defined as a representative sample of the stock market. Index funds were created to quickly measure stock market performance. Rather than looking at hundreds of stocks over a day or a week to try to figure out how the stock market is doing, indexes were created to take a quick snapshot of what's happening. An index is just one simple fund that represents how the stock market is doing that particular day. ETFs. Let's jump into ETFs. These are exchange-traded funds. ETFs were introduced about 15 years after the creation of the first index fund. They're very similar to index funds, except for this one major difference. You can only buy and sell index funds once a day. However, an exchange-traded fund, you can buy and sell like a stock. This means you can trade it on the stock exchange multiple times a day, providing the stock market is open. Even though an ETF is not a stock, it acts like a stock in its performance and tradability. Now, it's really up to you to decide what you want as the investor when it comes down to choosing an investment vehicle. Ask yourself this: do I need the 24/7 tradability of an ETF, or am I good with a simple index fund? Now, here's my recommendation. ETFs can sometimes get you in this state of mind of gambling, and you're watching the ETF go up and down throughout the day. You're watching it climb and fall, and sometimes that can create gambling-like behavior in your mind. I've just noticed that for me is not the best way to encourage good behavior when it comes to investing. It really only encourages me to impulse buy and try to time the market as it's going up or going down. The bottom line is that humans have this gambling-like behavior. We have this bent towards get-rich-quick schemes, and it just makes us want to buy and sell. This is actually the opposite of smart investing. Another reason I love index funds, and we'll conclude here, is the convenience of automatic investing. Automatic investing allows you to set up an automatic investment into a particular index fund of your choosing, the S&P 500, the total stock market. An ETF doesn't give you the convenience of being able to do that. Every time you want to buy more shares of an ETF, you physically have to go on and purchase more shares. But not only that, some firms will actually charge you a trade commission every time you purchase more shares of an ETF. With an index fund, you don't have to do that. You can set everything up automatically, and for me, I just noticed this really encourages good behavior. An index fund, you don't have to do that. You can just set it up and it'll invest for you. If you're not sure whether to go with an index fund or an ETF, might I suggest going with an index fund? Most investors will only need to buy into a fund rather than trade it until retirement, when you begin withdrawing your money. If you remember, we talked about our 8 money habits, link in the description below. One of them is automating your finances. Just automate it, set it and forget it. This is probably one of the single biggest things to outsmarting yourself and creating wealth over the long term. Well, I hope this gave you a better understanding of mutual funds, index funds, and ETFs, and how there's some similarities and some major differences regarding each of them. Do me a favor and comment below as to which one you're going to invest in, and I want to hear your reasons why. I think it'll be really helpful for a lot of other viewers to be able to see why other people are investing in these particular investment vehicles. Hope you enjoyed this video, guys. Remember, if your money could talk, it would say, "I'm a means and not an end. I'm a tool and a test. I can add meaning to life, but I'm not the meaning of life." Have a great day.